Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to interim income statement and tax estimate with a Q1 loss. There's going to be a loss in the first quarter as we work through our income tax estimate. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area in our worksheets on the right-hand side. Those worksheets will include an estimated effective annual tax rate as of the end of the second quarter, Q2. So we're going to be thinking that we are in the second quarter at this point in time, and we're going to be putting together the information as of that point in time, an interim time period then for the 3 months ended second quarter. Computation of the ending inventory. So we'll have to take a look at a computation related to the ending inventory income statement for the 3 months ended June 30th. So that's going to be the second quarter income statement that we will be looking at. As we consider the income statement for the second quarter, we will have to consider the tax estimate. And when we consider the tax estimate, we're going to have to consider what happened in the first quarter with regards to the tax estimate as well. So let's go and take a look at our information on the left-hand side. We're going to be doing an interim income statement and tax estimates with a Q1 loss. So a little bit different than the prior problems we have seen in that the first quarter, we're going to have had a loss on it and see what the effect of that will be, basically mainly in focusing in on the income tax calculation, the estimated tax for Q2. So we have our information. Q1, quarter one, loss before taxes was $115,000. And then we have our information for the quarter two. So the quarter two sales, that's the quarter that we're going to be focusing in on. Q2, quarter two, $1,225,000. Q2 purchases, $675,000, and operating expenses of $343,000. Then we have the first in, first out method is going to be used. Inventory. So we're going to have the first in, first out method. For the inventory flow assumption is what we're assuming here. Inventory at the end of Q1 reduced to lower of cost or market. So there was a reduction of inventory in Q1 to the lower of cost of or market. So it was reduced by 23,000, reduced to 99,000. And then in Q2, the quarter that we're looking at, replacement costs recovered, and by the end of the period, market value exceeded the ending inventory by cost by 21,000. So we'll make an adjustment related to that lowering and then it bouncing back there. So then we have the ending inventory estimated using gross profit method. Estimated gross profit rate is going to be 46%. So once again, the ending inventory is estimated using a gross profit method. So we're going to use the gross profit method to estimate the ending inventory, and then the estimated gross profit rate in order to do that was the 46%. Then we have the Q1 effective annual tax rate is going to be 45%. So that's what the effective annual tax rate was in the first quarter, Q1. We're now focusing in on the second quarter, Q2. Expected annual income at the end of Q2 was $610,000. So we're at the end of Q2 then, in other words, is what this piece of information is saying. And then we're projecting what we believe the annual income will be. So we're looking at the annual net income that we're thinking about as of this point in time, which is the end of the second quarter, Q2. Then we have an expected credit. This is an annual credit that we expect to see on the tax return, so we're going to need to take that into consideration with our tax calculations. $15,000 dividends received deduction. This is a difference between the book and the tax. $75,000, and then the federal and state tax rates. So the federal, state, and tax rates that are going to be applied to the taxable income, 40%. And then we have the tax benefits from operating losses are assured beyond a reasonable doubt. Prior year income available for operating loss carrybacks is going to be $50,000. Okay, so let's go on up to our information. We're going to start with an estimate of the effective annual tax rate. So notice what we basically have to do. We got to think about, we have to annualize our income because we're in the middle of the year. We're in an interim time period at the end of the second quarter. And one of the things we will need to do is figure out the tax effect as of this point in time. We cannot just use, the net income and multiply it times a rate because there's a couple different complexities. One is that there could be a progressive tax system. So we got to figure out, what rate would be the taxable rate at that point in time, or an average rate or some effective rate that we can then use there. Then we also need to consider the fact that there's going to be a difference between the book value and the tax value. That means that in order to get the proper rate, then that means that we're going to have to annualize our income. So we'll have to annualize basically our income. We'll take the difference between the book and tax differences. So we'll have to account for the book and tax differences to get to basically the taxable income. And then we can apply the tax rate. And once again, we're going to apply all income tax, which includes federal and state income taxes, and in that tax rate. And then we want to take into consideration the credits that may be applied, because those aren't going to be included in the calculation of the income tax rate, so that we can come up with an estimated effective annual tax rate that we can then apply to the interim quarter. And we could just apply that one rate to the interim quarter, which is going to take everything into account, the changes from the tax to the book and the credits that are being involved. Instead of having the complex tax calculation to do it, we'll be able to use that rate. That's going to be the objective. And then when we go to our income statement, we can apply that out. However, when we think about the income statement, we are then going to have to think about what happened on the first quarter, because we made an estimate for the first quarter, which of course isn't going to line up exactly for the estimate in the second quarter. So we'll have to then think about what happened in the first quarter to determine what the tax will be in the second. Estimated effective annual tax rate as of the end of Q2. We're going to start off with the income from continuing operations. So we're looking at Q2 income from continuing operations given us in the data down here. The expected annual income at the end of Q2. So again, we're looking at the annual income as of the end of the second quarter. So we're going to say there's the 610. That's what we expect the net income to be for the entire year. And let's just read the name of this thing one more time. The estimated effective annual tax rate. So we're looking for the effective annual tax rate as of the end of Q2. So as of now, Q2, we're looking for the effective annual tax rate, the tax rate, for the entire, that we would apply to income for the entire, basically, year. Okay, so then we're going to make our differences for the permanent differences. One's going to be the dividends received deduction. There's a dividends received deduction we expect to be $75,000 here, and we're going to say that that's going to be a permanent difference. So we're going to say negative. I'm going to say negative of that $75,000, and that will then give us our estimated taxable income. So we'll have the estimated taxable income. I'm going to then sum these up, which will subtract them out. So I'm going to say equals the sum of the 610 minus the 75. I'm going to sum them up, which will subtract them to get the 535,000. Then we got the combined tax rate. The combined tax rate is going to be equal to, we're looking for the combined tax rate. They gave us federal and state tax rate combined 40%, we're going to say. So 40% the combined tax rate. And that's on the year, the expected, combined tax rate for income taxes. And then we're going to multiply that out. That's going to be the 535 times the combined tax rate of the 40%. That's going to give us the 214,000. Then we're going to take into consideration the credits that are going to be involved. We expect on the year, I'm going to put a negative, and we're going to pick up the credits that we expect on the year, which is going to be 15,000. 15,000 of the credits that we expect for the year. That's going to give us the expected income taxes. Therefore, we have the expected income taxes. I'm going to sum these up then, equals the sum, which will subtract them out, the 214 minus the 15, and that gives us the 199. And then we can calculate the estimated effective annual tax rate, which of course was our goal. We're going to be taking, this is going to be equal to the 199 divided by all the way up top, the income, right? The net income, not the taxable income, the actual income that we expect annualized. Now we have something that we can apply to basically net income, right? So now when we think about the quarterly or interim areas, we can think about applying just one rate as opposed to breaking out the credits and thinking about the differences doing this long calculation. So that should simplify the process now. So the next thing we're going to do a computation of the ending inventory, because the ending inventory, you'll recall down here, was estimated using the gross profit method. So let's do a calculation of the ending inventory. We're going to start with the beginning inventory here. This is kind of just an alteration of the cost of goods sold formula here. So we're going to say beginning inventory was 99,000. Then we had the purchases that happens, cost of goods sold type formula going into play here. Cost of goods sold formula. The purchases then was going to be the 675,000. That's going to give us our goods available for sale, the goods that we could have sold throughout the time period. Summing these two numbers up, the 99 and the 675, giving us the 774,000. Then we're going to have the estimate cost of sales. So instead of going to ending inventory as we normally would here, we're going to kind of reverse the last two because we're going to be using this estimate for the ending inventory. So the rate is going to be down here. We got the estimated gross profit rate. Now we're looking here at the estimated cost of goods sold. So we're going to take 1 minus that rate. So we're going to take then the sales, the 1,225,000 for quarter 2 times 1 minus that rate. So it's going to be equals, we're going to say this equals the sales number times brackets 1 minus, and then we'll pick up that 46 as the rate, closing up the brackets, and there we have the 661,500. That's going to give us our ending inventory. Ending inventory then is going to be equal to the 774,000 minus the 6615 for the 112,500. Then we're going to start the income statement for the second quarter, that being quarter 2, that being for the 3 months ended June 30th. So we're in the second quarter income statement. So we'll pick up the sales first. So we'll pick up the sales. I'll put that in the outer column. That's given to us in the data up top. So I'm just going to pick that straight up from the data. So we're going to pick the 1,225,000. Then we'll take a look at the cost of goods sold. I'm going to do the cost of goods sold formula now and break it out, reversing the order here. So we have the standard kind of cost of goods sold formula, and we will have to take into consideration this little reversal that happened here with regards to the lower of cost or market. So we're going to start off with our cost of goods sold formula. We typically start off with the beginning inventory. So that's what we'll start off with here. Nothing unusual. We'll take that. I could take that right from the calculation we did up top. And then we're going to have the purchases. We can actually take that right from the information up top. Purchases, we're going to get to the same spot. That's going to give us the goods available for sale. Goods available for sale. Summing this up equals the sum of the 99,000 and the 675,000 for the 774. Then here's where we change things up a bit because we're going to do what we would normally do here, which is now take into consideration the ending inventory, which we did in our calculation up top. I'm going to make it a negative number here because we're going to subtract it. So there's the ending inventory, which was the 112,500. And that's going to be a subtotal because we're not quite there yet, because then we got the recover from lower of cost or market because of this issue with the lower of cost or market related to the inventory. So let's just take a look at that real quick. Up top, we have the first in, first out inventory method used. So we use first in, first out inventory in Q1 reduced to lower of cost or market. So it was reduced in Q1, reduced by 23,000, reduced to 99,000. In Q2, the replacement costs recovered, and by the end of the period, market value exceeded the ending inventory cost by 21,000. So that means our beginning inventory, basically, the ending inventory for Q1 was reduced to 99. So our beginning inventory was reduced here. Within our cost of goods sold calculation, we're then going to make an adjustment for the cost of goods sold for the 23,000 reduction here. And that will give us then our cost of goods sold. So just a little bit of a added detail, a little quirk in our system here. We're going to be taking the 661,500 and the 23,000 to get us to that 638,500. So then we're going to calculate our gross profit. So the gross profit calculation, of course, will be sales minus the cost of goods sold. So that's going to be a straightforward calculation. This is going to be the sales of the 1,225,000 minus the cost of goods sold, 638,500, gives us the 586,500. Then we're going to pick up the operating expenses. So let's pick up the operating expenses. Then we're going to pick up the amount. I'm going to make it a negative number by saying negative instead of equals, and we'll go all the way up top to pick up that amount. That's going to be the $343,000. So there we have that. And then we're going to have the income before taxes. Income before taxes is going to be, I'm going to sum up these last two numbers, which will, of course, we'll subtract them out given the fact that the second number is a negative number. So we're going to get then to the $243,500. Then we got to calculate the income tax. So now we got to calculate the income tax, and you would think that we could take just that $243,500 and multiply it times this 31.62, the effective annual tax rate, but can't do that quite that straightforward because we need to consider what happened in the prior period, in period 1. So I'm going to say, all right, let's think about that. We're going to do a little worksheet here. We're going to say in period 1, we had this loss. So we had a loss in period 1, and the loss was for $115,000. $115,000 on the loss. Year to date, let's make that a negative because it was a loss by deleting the equal sign. Year to date's the same number because it's the first quarter. So then the annual tax rate that we had when we did this calculation for period 1, we came up to an annual tax rate for the first quarter, as of the end of the first quarter, effective annual tax rate of the 45%. So that means that the year-to-date tax would be the $115,000 times the 45%. Now, notice that's assuming that we can get some benefit basically from the loss, because this is a tax benefit because we had a loss. So we're basically, if we're going to say that we have a tax benefit in Q1, then we're assuming that we're going to be able to, assume or take that tax benefit by basically carrying it back possibly to prior year. And so that's why down here in our data, we had this prior year income available for operating loss. I'm actually going to, let's up this a little bit for it'll be in your problem, $55,000, just to make it clear that we could take the operating loss there. So our assumption then is in Q1, then we had that benefit, basically a tax benefit from the fact that we had a loss in Q1. Okay, so then we're going to pick that up and report it in this period. And then in Q2, then what happens in Q2 now? Well, now we're saying that we had the taxable income or the income before taxes that we just calculated at the $243,500. And if we were then to take into consider the prior period, we would say this is year to date equals the current 234.5 plus the negative 115 above it. So this number minus this number gives us the 128.5. Then we're going to take our rate. So this is going to be equal to this 32.62. I'm going to add some decimals here so we can see the decimals. And so there we have that. So then we're going to say at this point in time, then we've got the 128.5, including the income for the second quarter minus the loss of the first quarter times the rate would mean tax of the 41,920. So last time we had this like benefit here, tax benefit in essence, and this time now we have to actually pay taxes, right? So if we take those two into consideration, now it flipped from tax benefit to actual taxes. So if we subtract these two out, the 41,920 minus the 51,750, now we have 93,670. That's going to be the actual number in the second quarter, considering the fact that this 128.5 is taken into consideration a loss that was in the first quarter. So now we actually have tax in the second quarter of the 93,670 that we need to be applying out here. So we're going to say, all right, taxes then second quarter Q2, it's going to be this 93,670, and that will then give us our net income, of course, and we'll pick that up. That's going to be equal to the 243.5 minus the 93,670 to give us the 149,830.